in gold. This has been something in GDX, the gold miners ETF. You want to look at a ratio versus the S&P, but this is something you've been active in over the last year. You see this, and I know Guy does too, and I can't wait to get his commentary on this too, but you guys see this as just a really great risk asset in the sort of macro environment that we've been in over the last couple of years, where the Fed has really dictated a lot of the action as it relates to rates and currencies and the like. And, gold is really kind of been a star, I guess, over the last 6 months or so, but it definitely came in a little bit over the last few weeks. You want to think about it going the other way now.
Right. I mean, look, it's a great mystery. Half the world think gold goes up because of inflation. Half thinks it's deflation, right? You hear expressions. I've used it myself. Gold, rates to zero, gold to infinity. I mean, if rates go to zero, does gold go? But at the end of the day, it's still just a trading vehicle, and there are flows, and there's buyer, and there's sellers, and at some point we try to catch the direction right. Today's note to clients was just responding to or following up on a January 13th note, which was saying trim. We were going up and up and up and up, and the thought was, let's just pull this back a little bit. Now that we've sold off, I think you put back on that which was trimmed.
Mm-hmm. I agree with that. And if you look, Dan, you see an M&A in the space for the first time in a while. Yeah, on the margins, but I think you're going to see continued M&A in the space. I've mentioned it dozens of times on Fast Money on our shows that central banks continue to buy gold back in record amounts, and I think that will continue. You see what's going on with the Bank of Japan. I'll use the word that they seem to be flailing a bit in terms of their currency and their bond market. Obviously, you see what's going on here. We talked about the 2s, 10s inversion. Carter's right. I think people are confused as to why gold works and why it doesn't work. One would think that gold's doing extraordinarily well in this environment, given the fact that inflation is a problem, but it's been somewhat muted because the Fed is trying to fight that inflation. I think gold is taking its cues from there. But I happen to think, again, and I've said this a number of times, the chart has pulled back. You're right. But I still think I'm very constructive here in the price of gold. It's one of those stories that nothing happens until it does. And then when it does, I think people are going to start to wake up. Commitment of traders, which is something commodity traders look at. There's really nobody long in the gold market in terms of hedge funds and specs, which is actually very bullish for gold. So we'll see. The incremental buyer has been central banks. I think it's just a matter of time before the incremental buyer becomes hedge fund and specs. And when they try to get in a meaningful way, gold's not nearly as big enough a market to take in the kind of inflows that I think it's going to see.
All right, so Carter, let's talk about the GDX versus the SPX. You want to look at the gold miners. You also want to look at the Bloomberg precious metals, which is, it looks like, 80% gold and about 20% or so silver. And then let's just finish off by looking at the GLD because, again, that's one that I think a lot of our viewers look to trade here.
All right, so this is the relative strength line for gold miners as measured by the GDX versus all stocks as measured by the S&P 500. And you could say that looks like nothing. And to be fair, there's maybe nothing going on, but let's annotate it. This is what my eye sees. First iteration. Maybe go back and forth. Take them off, put them back. Look at those ovals. Now look at the next iteration. This is a sequence. We bottomed, you get a big move, and then you check back. It's underway. It's very similar to checkbacks in 15 and 18. And I think this is about where you get that pivot and you start to go again. So we like this. I think it's a great pair.
In layman's terms, Carter, what is the one that accelerates to the upside? So what happens under this circumstance? Obviously, I think you think GDX is going higher, but does it necessarily mean this SPX is going to move as well?
Well, you have to get something, right? And guys making the point that if you're going to get this line, which is going down, which means gold miners are underperforming the stock market, gold mining stocks, underperforming stocks generally. If the black line goes up, it can only be one of three ways. It means that the S&P is dead flat and gold mining stocks are doing very well, right? Or of course, you can have a little bit of both, right? But let's do the reciprocal is gold is dead flat and S&P collapses, right? Or you get a little bit of both, which is S&P kind of coming down, gold miners kind of coming up. My thinking is it can be any of those scenarios. I mean, I don't think you're ever going to get anything dead flat. That's not how markets work. So two of those three scenarios are kind of unlikely. I just think that you play this as a pair, and while pairs let me just say, pure pairs are relatively safe when you're doing Coke, Pepsi, Walmart, Target, right? This is not really a pure pair. So you can get this wrong both sides. You can put this ratio trade on and you can get it really wrong. But I think you're covered by the fact that you've had such a give back in the ratio that now is about where you get the balance.
All right, let's think about gold, the precious metal here a little bit, because you have this chart, and that looks like a very well-defined
Mm-hmm.
20-year uptrend, right? And you
Mm-hmm.
do see that downtrend from the post-financial crisis highs a little bit, and again, it feels like we're kind of in the middle part of this pennant a little
Mm-hmm.
bit here. But you
All
think
that.
that check back is here to be bought, and maybe a retest of that downtrend is in play.
Yeah, I mean, one could say, come on, you stuck that green arrow in there. If you didn't have that green arrow, who says that's not a pair of two? Fair enough. But you have to make a conclusion at some point. But the point of annotating a chart, putting in lines, is to try to see levels, reference points that will help one make decisions, or to show it to others who might not have seen it, right? And so, one, it's incontestable. It's a 20-year uptrend line. Now, this give back of the earlier this year, we didn't quite get down all the way to that well-defined uptrend line. We ricocheted, and we are kind of in the midpoint. To some extent, one could say it's a pair of twos. But you make your bets. And my bet is that ultimately, you look at the next iteration, it's the same chart, but that this is what's going on, right? That we're basically in the process of ultimately continuing higher. And there's something nice about this. Now, to be fair, you must know that this index, it changes the weightings. If silver has a big move, silver can get up to 25% or 27%, and gold comes down. But it's basically a 2/3, 1/3, 3/4, 1/4 kind of thing, which it should be, right? Because gold is a whole lot bigger and a whole lot more important. So.
Yeah, and it's interesting because silver really is going nowhere now. You had a brief move down in silver to the upside, but it's given some of it back. But to Carter's point, you could get one of these moves in silver as well. But this bet that I know you're going to illustrate an options trade on, Dan, is really predicated on gold doing something. And I think we both think that's going to happen. And we can take a look at the GLD chart just to sort of round this entire thing out and look and see where we've been, where we are, and where we seemingly are going. And, we're back down to levels that were resistance back in the summer. Past resistance becomes support. I think we're finding it. There were some people I think thought we'd get down maybe to the moving average. I'm not certain that's going to be the case. And I think we hold here and bounce, Carter. I mean, that's the way I look at this chart.
No, I think that's right. And one thing to point out, the absolute level of anything is what it is. But of course, inflation is an important part of long-term investing. So just to put this in context, we're sitting here at $18.20 an ounce, whatever, it could be $18.50, $1,800. But right now, on an inflation-adjusted basis, gold is the same level as it was in December 1980. Now, just to put that in perspective, in December of 1980, gold was $455 an ounce. And here we are at $18.20 an ounce. But it's the same level if you strip out the ongoing effect of inflation. So the notion that somehow gold is expensive or gold's gone, so it's the same price it was 42 years ago, right? Yeah. And there's no great runaway. To put that in perspective, oil's the same thing. I mean, oil, so ironically, oil can't stay this high. We get into recession. Oil's $76 a barrel. It's the same level as it was in December of 84. It was $34 a barrel. Is oil really that rich? Is that high? No.
Yeah, well, it's interesting. I think of this as gold, and I go back and forth between your technical take, Guy's fundamental take, and it just kind of it aligns to me as a good trading vehicle, like we just kind of described here, and kind of given what I think might happen in the S&P over the next month and a half or so. I want to get some long exposure here, and I was looking at the options markets, looking out to April expiration today with the GLD, the ETF that tracks gold, was trading about 169. You could buy the April 170, 182 call spread, paying about $3 for that, buying one of the April 170 calls for about $3.50 to open, selling to open one of the April 182 calls at about 50 cents. So again, that costs you about $3 or a little less than 2% of the ETF price. I have profits up to $9 between 173 and 182 with a max gain of 9 above 182. And I've lost up to $3 between 170 and 173 with a max loss of 3 below 170. So this trade idea, again, it risks less than 2% of the ETF price. I have a break even up a little less than 2.5% of the ETF price. And I have a max gain of about 5.3% of the ETF if it's up near those February highs. So that was up around 182. That's why I chose that kind of 170, 182. So I'm risking 3 to possibly make 9 if the GLD is up nearly 8% in a little less than 2 months. So I really like the risk reward of this trade. I like the technical levels. I like the fact that what I think as far as economic data and where we see kind of just sentiment moving in and around risk assets that should be exposed to rates and inflation and the like. And again, when I'm doing long premium directional trades, I am basically using a 50% mental stop to the downside. So for instance, if this thing were to go nowhere or the GLD were to go lower, well, those $3 in premium that I paid for this $12 wide call spread is about $1.50 or so, about 50% loss. I'm going to cut that because I just don't want to see that move to zero. And again, to the upside, I might look to take profits on half this position if it's a double at some point between now and April expiration. So that's how I'm going to trade these guys call here.
No, that's right. And just in terms of the math, if you get a double in something, if you take off half, you're in the rest of the trade for free. And to your point, I think when you look for trades like this, you're looking at least 2 to 1. In other words, you risk 1 to make 2. I mean, that's the low end of things, but a 3 to 1, the risk reward sets up really well, Dan. And I think you've given yourself enough time in terms of the April expiration to take into consideration a lot of things that we think are going to happen over the next few weeks. So this makes a lot of sense to me. I'm sure Carter's aligned with it as well.
Yeah, Carter, real quickly, do you think that sort of move, a little less than 8% between now, April 21st is the expiration for this trade? So here we are, we're almost at March 1st or so. Does that seem like a big move no, it doesn't. Okay, give us your take on this one real quickly.
It's so you adjust for beta for an individual equity. Equity needs news, but this is something that can come to life. Commodities have a way of doing that. It's a nothing move if things get going.